Lululemon reported quarterly financial results that disappointed stock market investors, and the stock price is down by more than 18% following the company's quarterly financial release. Of course, I'm disappointed in that, especially because I rated Lululemon stock as a buy, and I recently upgraded the stock to a buy following the company's significant price decrease already. Even before this 18% decline, Lululemon stock had been underperforming in 2025. And so after the stock markets closed on September 4th is when Lululemon announced its quarterly results. And the management team, the CEO specifically, said that while we continue to see positive momentum overall in our international regions, we are disappointed with our U.S. business and aspects of our product execution. We have assessed the drivers of our underperformance and are continuing to take the necessary actions to strengthen our merchandise mix and accelerate our business. And looking at their breakdown of the results, I can confirm what the assessment was from the CEO. Overall net revenue increased by 7% to $2.5 billion, but revenue in the Americas was only up by 1%. International net revenue increased by 20%. Now, I expect the management to really lean into their international business, and it's because of the sourcing outside of the United States. Lululemon has almost all of its manufacturing and sourcing outside the United States, so when it imports those goods into the United States, it has to pay a tariff somewhere between 15 and 50 to 60%, depending on the details of the specific items and the countries they're coming from. So if Lululemon ships those products outside of the United States, for instance, let's say they manufacture in China and they ship those products to Europe, they don't have to pay the tariffs to the United States. So that allows an outlet for the company's sourced products outside the United States, a destination where they can sell them to at lower tariffs or no tariffs in some countries. So I expect the management team to lean into international growth even more than they've already done. Furthermore, the U.S. business, I don't see any near-term fix. The gross profit margins declined by 110 basis points to 58.5%. This is a result of the tariffs the company has to pay to import the goods to the United States, and so that weighs on its margins. They've only recently begun increasing prices. Click the link below to watch the full video.